following is an update and technical analysis on the US Tech 100 NASDAQ futures based upon the daily interval, in which I will deep dive straight into the 10-year daily time frame, where we had some bigger headlines rock the market space in the midst of geopolitical chaos and additional economic uncertainty. The market trembled as Iranian missiles struck Israeli soil, igniting a surge in crude oil and gold. While safe haven seekers flocked to bonds, Wall Street's giants, big tech and Bitcoin, bore the brunt of the storm, battered by fear and panic as the specter of war sent shockwaves across every trading floor, where treasury yields tumbled, gold gleamed completely brighter, and oil rekindled its fiery risk premium, especially based upon that primary reactionary price support level that I had continued to cover in my previous crude oil West Texas Intermediate futures chart, roaring back to life on all but while as Union strikes ripple through American ports. The looming question remains: when will liquidity cease to be the lifeline and chaos unveil its true hand? And we are now overshooting the 786 fibs retracement, call it the 19,952 level, and that had significant major reactionary highs and lows. I had continued to hype this key additional level in my previous video there, and major reactionary low here. We had a very bearish tilt on a bear hammer candle, completely losing control in the buyer's realm, followed by an additional red candle, solid red candle close. You had your hyper reaction off the 786 fibs retracement once again, back tested it, fell short into the close, and here we are slightly below. The 786 fibs retracement has been undercut with conviction, with an additional add-on to your existing short trade position. If and when we were to counter trend snapback rally right into the 786 fibs retracement, it could look bullish. It could be a potential overshoot of that key inflection point. That's a 1.25% move to the upside. So it'll look extremely bullish on the daily interval, only to offer an additional great risk reward short trade setup to the downside on a rechallenging of the 50-day moving average and the 618 fibs retracement. Call it the 19,320 price support level. And that would be met with a fury. And that would be met with an additional, what you would call dual price support level. We are at a key additional inflection point on the moving average convergence within the foundation of the beginning stages of a bearish crossover. Make no mistake about it. In a large gaping on a 1226 close of the 9, that could be the additional technical damage that is infused into these indicators, only adding additional evidence that this could be the beginning stages of a breakdown sell signal off a minor primary uptrend line on an undercut of the 786 fibs retracement. And you have the stochastics 1033 already flash crashing down below on a bearish crossover below the 85 threshold. If and when we get the moving average crossover, that could signal an additional fire sale back down on a rechallenging of the 50% fibs retracement. You have your additional 200-day moving average and the concealed primary major reactionary uptrend line price support, called a triple transitioning level, where long traders and or bull traders would need to defend really at all costs to avoid some additional bigger, larger picture technical damage within the realm of the daily time frame. Short sellers, bear traders would want to see an additional big, solid, red-infused candle close below that key trend line support level to usher in what you would call the breakdown sell signal of the year, in my opinion, only increasing the odds of a much larger, deeper correction and crash, taking you out to the US 10-year off the daily interval. And in my previous coverage of the treasury markets, we had this primary reactionary uptrend line off the November COVID 2020 reactionary lows, had major reaction. And that would spell for an additional big breakdown sell signal in the yield there, only increasing the odds the Fed would begin the cutting phase of the next cycle. And that was backtested on a false breakout off a momentum-fueled overshoot. We backtested that primary reactionary uptrend line, and it never looked back since. Completely crashed. The Fed unleashed a 50 basis point cut to their monetary policy. And here we are dancing among what you would call a bullish falling wedge pattern. And here we are now dancing within what you would call a bullish falling wedge pattern. And that is as technical. And you want to talk about a technical induced pattern. You have positive and bullish divergences really constructed amongst all four key technical momentum indicators, only increasing the odds that you would be within the beginning stages of the bottoming and a major rally within the 10-year yield. You had a breakout off that primary reactionary uptrend line. You back tested it, and the yield bounced right off of it. This would signal potential for a sell-off in Bondville, only increasing the odds that a yield screams to the 236 fibs resistance target one of 3,941, and that would be a key additional level for a rechallenging. Bear traders, short sellers, bond vigilantes would need to have that level taken out with conviction on a solid daily big sell-off in the 10-year bond for an increase surge in the interest rate of the 10-year. As the 2s and the 5s yield curve inverts, signaling a brewing storm on the economic horizon, where we stand at the edge of uncertainty, where the inversion whispers of potential turmoil, a harbinger of shifts yet to unfold. To read the signs hidden in the turbulence will seize the true opportunities that lie within the storm.